Nancy Davis is CIO of Quadratic Capital, a firm that specializes in quantitative analysis and strategy. She correctly predicted the short volatility blow-up at the start of the year, and 2 weeks ago warned us the Nasdaq 100 was due for a pullback. She is back with us, as you see today on set. It's good to see you again.
Thanks for having me back.
So we're down about 2.5% on the Qs since then. Does it feel like there's more to go?
Well, as we discussed 2 weeks ago, the rally in the Nasdaq was driven by just a handful of stocks. And the same thing has happened now. The pullback has been led by just a handful of stocks. Facebook alone accounts for about 30% of Nasdaq's sell-off since February 13th.
Facebook, it's Netflix, some of the glamour names we said, but it's been spread around a larger area of tech. I mean, how much further does it have to go? We've seen episodes like this before, and they've been short-lived. Is this different?
You know, I think there is a lot of complacency in the market. We have had years and years of central bank money printing, and the economy is doing very well. I guess I would question whether things are really as wonderful as Mr. Wonderful says. And I look a lot at China and what's happening there in the tech space, and the Chinese markets are still down substantially and also very tech-focused. So you still have this divergence, which is what we were talking about 2 weeks ago, between emerging markets, which have sold off tremendously, and the Nasdaq, which is still up very healthily this year.
So you're saying there needs to be a catch-up to the downside to some of the pain that's been felt in emerging markets?
Either EM's going to rally or the Nasdaq and U.S. might sell off as well. You
have any sort of indication from the stuff you're looking at that tells you which way that could break?
We do think the asymmetry in the market is definitely better outcomes for the downside at the moment. We do think there's a lot of complacency. The cost of owning volatility, which is the cost that you pay to buy an option, is very, very cheap. So the asymmetry that you can achieve with options, we like owning sort of the innovation, the technology, the still owning equities, but also diversifying with some front-end investment-grade credit, given the number of hikes and the sell-off that we've seen in IG, as well as having option overlays to hedge the market beta. So you can still look at the trees, but you can hedge the forest.
Nancy, to your point, how should we view the lack of volatility rising as these FANGs have declined so significantly? That hasn't occurred.
It hasn't occurred. The world is still hungry for yield. And a lot of the yield-generating strategies are in something called risk premia. That's the latest hedge fund buzzword these days. And they sell options, which is selling volatility. So there's this natural supply, you know, of what's going on in the market. There's still a search for yield, a search for alternative yield enhancement, and that's taking place still today.
And when people don't get hurt, obviously they got hurt post-February when we had the blow-up in that one volatility ETF. Or ETN. But in this case, like you said, when you were on, very accurately called, the VXN was approximately 1650, 17, shot up through 20. Now it's pulled back 5 or 6% just today and is back down to 1940. So is that telling you maybe that the people that had it, let them have it, sold it out when it spiked like that?
Yeah, so a lot of these strategies are systematic. And so even when you have market dislocations, they keep selling options, they keep selling. And what they're trying to do, just to break out what is risk premia, it's trying to extract the implied vol, which is the market price of implied volatility, versus realized, which is what actually happens.
And profit off the delta.
And profit off delta hedging.
Your comments on emerging markets, where do the trade war hysteria that the press plays on fit into that? Because EM looks very attractive right now as a long investment for the rest of this calendar year. Trade I'm looking at, because the trade wars don't seem to matter outside of the press. Why don't the markets react to any of that?
I think it's especially interesting in the rates market because inflation expectations, if you think about if we have trade wars, that's going to mean a price of higher goods to us all. Your iPhone, the components in it, everything will have a higher price. And so it's amazing to me that the rates markets haven't adjusted more because of all of the concerns on trade wars.
So it must mean they don't think we're going to have trade wars at the end of the day. This is a big negotiation. But where does it sit on going, if you had to put money to work in EM for the rest of this year versus the S&P, what do you like better?
I like EM better. But again, I'm all about the probability distribution, and EM has more of a likelihood to move than the U.S. at this point, especially with the Nasdaq where we are this year.